Are you ready to capitalize on this earnings season? In this video, I'll reveal two smart strategies that leverage the surge in implied volatility, giving you the edge you need to potentially grow your account with calculated moves and well managed risk. Hi, my name is Gautam, and on this channel, I talk about the stock market and achieving financial freedom with the power of options trading. So, if you enjoy content that can help you retire early and achieve financial freedom, don't forget to hit that like button, subscribe to my channel, and share this video with your friends and family. Also, if you are new to the options world or are simply looking for one-on-one guidance to help you shortcut years of trial and error and avoid costly mistakes, click on the coaching link below and I'll be honored to help you out. With that said, let's dive in and get started. For my first strategy, we will take Snap as an example. Now, if you have a teenage kid in the house like myself, you know they're constantly on social media, and Snapchat is definitely one of the popular choices. Now, Snapchat is not profitable just yet, but I do know it's not going anywhere, so I don't mind trading this stock. Additionally, we've had positive analyst reviews on the stock this week, increasing the price targets to $10 and $12 respectively. To top it all off, the stock pays great premiums and is currently trading around the $950 mark and is also a great pick if you have a small account. Snap is expected to report earnings after market close on 8/5. So I'm going to show you how to take advantage of that implied volatility and collect some juicy premiums on Snap. Now I have the Snap options chain pulled up on Thinkorswim. And if we go to the August 8th options chain, because Snap reports earnings after hours on August the 5th, so we're going to go ahead and select this options chain. Now, the first thing to keep in mind when trying to do an earnings play is to look at the expected move. Looking at the expected move that the market is pricing in for Snap, we have a plus or minus 1.94 from the current price. So Snap's currently trading at 951. So if we just pull up the calculator and just do 951 minus, it was 194. So we're going to do 194. So on the downside, that brings us close to the 760 mark. Now, since I'm an option seller and I like to take advantage of implied volatility, this is what I'm intending to do. I'm going to pull up Snap's 6-month chart. And if you look at where Snap's trading currently, it's in between the top and the middle of the Bollinger Band. It's around the 951 price point right now. Looking at the next level of support, that would be the middle of the Bollinger Band. And the middle of the Bollinger Band right now is around 883, which is obviously some discount to the current price. Now, considering we have earnings in the mix, we want to be super cautious and only pick up the stock at a price that we're comfortable owning the stock. So in that case, I'm going to go down a little further and look for additional levels of support. So we have additional level of support at the 836 level. And then I also have further support at this $8 level, which is the bottom of all these candles right here. It's 797 or close to the $8. Now, then you obviously have the bottom of the Bollinger Band, which is 768. But considering where the stock is right now, I think that's probably too big of a move. So we want to find a nice balance of good premiums, but also being safe with the strike price that we select. So keeping that in mind, let's go back to the options chain. And I said, again, support at the middle of the Bollinger Band, which is the 866 strike price. And then we have additional support at the $8 level. And then we have the bottom of the Bollinger Band, which is 768. If we go to the August 8th options chain, now I know they're reporting earnings in the middle of the week, which is August the 5th. But since we have weekly options, we're going to have to pick the August 8th options chain right here. We said earlier that the expected move brings you close to the 757 mark. So the 757 would be even lower than the bottom of the Bollinger Band. So keeping that in mind and the 757 strike price, let's look at the options chain right now and see how much premium we'd be able to collect with the 750 strike price. Again, I said that's actually even below the bottom of the Bollinger Band. And if you go with that strike price right now, the 750, that's a 14 delta. And the current rate of return with that strike price is about 3.96% or 4%. Obviously, the implied volatility is higher. If you look at the options chain right here for the next few weeks, we have implied volatility of 61%, 52%, 53%, So as you can see, the average implied volatility for Snap is in between the 52 to the 60% range or 61% range. But in this week, the implied volatility is 99%, obviously because of earnings. So we said we have the 7.5 strike price that's offering us 18 cents or $18 if we put up a collateral of $750. Or if we go with the $8 strike price, which I like because it's a healthy mix of choosing a price that you're comfortable owning the stock and also trying to collect good premiums. And the $8 strike price is right now offering us a return of 3.9%. Considering that I don't want to take a full on risk in the earnings week, what I intend to do is actually go out another couple of weeks. And if you see the implied volatility for the August 22nd options chain is about 84%. Now, granted, is not as awesome as the earnings week, but I'm also giving myself additional cushion in case the stock does drop. So again, you want to take risk and take advantage of the implied volatility, but be also safe and give yourself some extra room in case the stock does drop big time. So what I did was I went with the August 22nd options chain. So I went with the $8 strike price. And as you can see, going with the $8 strike price, I'm still getting a return of 4.71%. And this is basically going 37 days out. So that's how I am playing Snap, being cautious, but at the same time taking advantage of the implied volatility, selling put options at a strike price of $8 and collecting some nice moolah doing that. For my next strategy, I'm going to use Google as an example. Google's a great company currently trading at a PE ratio of 20.51. Now, it's definitely undervalued and hasn't performed as awesome as the rest of the market. Looking at the year-to-date return on the S&P 500, Google's actually down year-to-date 2.57% compared to a 6.3% increase in the S&P 500. Also, the S&P 500 trades at a PE ratio of about 26-27. And as I said, Google's PE ratio of 2051 is definitely a lower for a great company like Google. Now, Google's expected to report its earnings on July 23rd after market close, which is actually next week. I'm recording this on Wednesday, July 16th. Since we have weekly options on Google, the next options chain that would include earnings would be the July 25th, which is for next week. And if you look at the expected move right here, we have an expected move of about $12 on Google. So keeping that in mind and the current price, Google's currently trading at around 184, and we're going to take the 184, we're going to add $12 to that. So that gives you on the upside a price of $196. So subtracting $12 from 184, that gives you a price of 172 on the downside, and we said $196 on the upside. So what I plan to do with Google, of course, you can do this with any stock of your choosing, but Google's a good example. So I'm going to build an iron condor on Google with these two price points. I'm going to go to the July 25th options chain. We said that on the upside, the top price that Google's expected to go to is the 196 strike price. So I'm going to go even more safe and go to the next price right after that, which is the 197.50 strike price. We're going to hit the bid price because you want to sell this. Now I'm going to go up 5 strike prices to the 202.50 and I'm going to buy this call option. And basically what we built is a call credit spread. We have to build the other side, the downside of the iron condor, which is the put credit spread. And for that, we said that if we subtracted $12 from the 184 strike price, then that would be the 172 strike price. We could possibly go even safer than the 172. We could go to the 170 strike price. And I'm going to click on the bid to sell this options contract. And then we're going to go down another 5 strike prices to the 165 strike price. And I am going to go ahead and buy this options contract now. So if we build one iron condor on Google, right now we're getting a premium of $1.25, or that's $125 for one iron condor. Now, if we go ahead and sell 5 iron condors on Google, then you could collect $625 doing that. So looking at the P&L chart, all we need for Google to do at expiration is to stay in this green zone right here, which is the 170 strike price at the bottom end. And on the top, we have the 197.50 strike price that we chose for the call option that we sold. So all we need for Google is to stay in between the 170 strike price on the downside and the 197.50, and then you get to pocket 100% of that premium. Since I'm going with the width of $5 for the iron condor, and we have 5 contracts, so the max loss in this case would be the $5 times 5 contracts, which is 25 times 100 shares, because each options contract represents 100 shares. So your predefined max loss for this trade is $2,500 if you go with 5 option contracts, or if you simply open one options contract and sell one iron condor, your max loss would be $500. So if you go with this selection, then you would end up collecting $625 by selling 5 iron condors on Google. And those are the two strategies that I plan to deploy this earnings season and take advantage of the implied volatility and elevated premiums. So that's it for today's video. If you enjoyed it or learned anything useful, don't forget to hit that like button, subscribe to my channel, and comment down below with your thoughts or questions. If you would like one-on-one coaching directly with me, click on the first link in the description below, and I'd love to help you out.